Okay. Chapter 12 is the most powerful chapter in the bankruptcy code. Many people wonder, how can I say that? Why is it the most powerful chapter in the bankruptcy code? For many reasons, it's the most powerful chapter in the bankruptcy code. Think about Chapter 11. What's the nemesis of a Chapter 11 debtor? Let's see. We have unsecured creditors committees. We have this absolute priority rule. We also have this little problem out there getting acceptance. We need to have greater than half a number and 2/3 in amount in favor of the plan if we're going to do a cram down. Well, got to deal with all the classification problems. Those are all reasons that Chapter 11 doesn't work well for farmers. And in the 1980s, Senator Grassley understood that. And in 1986, Chapter 12 was born. Well, Chapter 12 was handicapped for a long time after it was born because it didn't deal with the taxes. Unfortunately, a lot of times, the best remedy is to right-size the farm. And by right-sizing the farm, you're selling assets. You may be selling land, you may be selling breeding stock, you may be selling machinery. Well, every time you're doing that, you end up with a tax bill generally. And Chapter 12 was ill-equipped until 2005 to deal with that problem. So let's think a little bit about what are the farmers facing today. Let's see here. Okay, I just did a little bit of checking online before when I put this together. Corn prices have been going up. They kind of bottomed out in late October there. Actually, they were lower still in late August into September. Now they're up to about $4.91. They're telling us in Iowa the cost of production's between 4 and 4.25 a bushel. Soybean prices, they're coming back up, $10.49. Not great. I like that $12.50, but I go back a few more years, and we go back in not that long ago, we were at 15 and 16. Wheat prices, well, they're not where we'd like them either. Lean hogs, well, lots of my hog farmer clients are having trouble right now with corn at $4.91 and lean hogs at about 87. It's kind of tough sledding. Let's see. Cattle, that's kind of the bell ringer here. Cattle are doing very well. I've got several clients who are cattle feeders, and no, not all of my clients are in bankruptcy. So I actually have some that are out there making lots of money and enjoying it. Milk, $20. My father stopped milking in 1977. He was getting paid $17 a hundred. Today it's only 20. And we know what inflation has done. And at $17 then, today would probably be upwards of 40. It's proportionally less profitable. You're getting less per 100 pounds of milk now than you were when my father stopped nearly 50 years ago. Let's think about the realities of the farm debtor. I've actually taken this from one of my clients. 2021, his total assets were $9.9 million. His liabilities were 4.8. He had equity of slightly over $5 million. 2 years later, his assets had increased in value because land prices were going up. He's now worth assets at 12.8. Liabilities had gone up though too because the interest rates had gone up. He hadn't retired the debt he had. Now he's gone up in debt about $2.2 million. Now the assets went up just shy of 3, but his debt went up almost dollar for dollar, or 2/3 of it. His equity went up a little bit. Well, fast forward to last summer. Machinery prices had started to drop and land prices had started to drop. His total assets are 11.8. His liabilities at the time are about 8.8. His equity now is down to $3 million. Unfortunately, this is not a farmer that's going to survive and thrive. This is a farmer that's going to need debt restructuring and probably Chapter 12 to deal with the significant income taxes he's going to have when either he sells out voluntarily or the bank chooses to help him sell out by foreclosure. Okay. I'm going to pass through the slide. It's from 1980s, and I thought I had that worked out, but as soon as I go to share my screen, it doesn't share the sound. So I'll work on that for the next time I do this one. Apologize about that. It's 3 guys from northern Indiana, and they happen to be relatives of John Mellencamp. And Mellencamp has some interesting farm songs out there. And this was done in the 80s. And at the time, these farmers were talking about what's going on and that government just keeps printing money and doing things like that. And it doesn't bother the government if we win or lose on this thing. I'm working 10, 12-hour days. If I'm good, I might break even. That's the tune a lot of my farmers are saying today. Now, are those that kept their debt low? They're able to operate a profit. A lot of them didn't keep their powder dry or didn't pay down the debt. Another one of my farmers came in, and Schedule F, he'd lost $32,000 in 21. 22, he lost $77,000. 23, he lost $252,000. Yeah, don't pay off debt, and you're not going to stay in business when you're losing money like that. The farmers are going to also have other trouble. The other trouble is they right size their operation. One of my debtors back in 2007, we did the analysis. When they sold down to right size, the federal tax was $74,000. State tax was $34,000, $35,000, so about $109,000. We used the Chapter 12 and they didn't have to pay any of that tax. 2018, another farmer. Federal tax on right sizing, $534, state $152. Section 1232 allowed us to avoid almost $700,000 in taxes. Last year, one of my current debtors, we look at federal tax projected to be $1.3 million, state tax about $600,000. Chapter 12 will help them get rid of those taxes. That's the reality. The farmer's out there scared to death. He'd rather keep farming to avoid the taxes because he's scared, because he says, I know what the IRS can do. And so he wants to keep farming, but why keep farming if you're losing money? The farmers are also out there with family problems. So you can just imagine this discussion. He's saying, I'm working my ass off trying to do the best I can to make a living. She says, you're never home for me. You're not home for the kids. And besides that, the balance sheet and cash flow show us that we're going backwards. This is no way to live. This is a discussion that I just had with a couple of 29-year-olds from Northwest Missouri yesterday. And it's a tough situation for folks. There's a lot of time that you'll have substance abuse. The people are scared to death. They can get very depressed. Yeah, they're confused. They're angry. I remember back in the 80s, the farm crisis days of that time, and a farmer went into Hill's Bank and killed the president of the bank. He ended up going to jail for life. The daughter of the banker is now a law professor. But they can be out there. They can be thinking of committing suicide. Don't be surprised if you'll hear about calls where a farmer is confused and they're saying it's time to just end it all. You know, that big life insurance policy got out there. My family would be better off without me. I've had to talk a number of farmers down. So let's think about Chapter 12. One of the qualifications is that greater than half of the income is coming from farming. So you'll see in Exhibit 1, and Exhibit 1 is using a different set of tax years. We updated the slides, and I wish now I hadn't. Don't worry about that. Going back in here and looking at us. Okay, there we go. Yeah, we start out, they were 2007, 6, and 5. Hubby and wife came to my office. They each owned 50% of a company that we'll call Farm LLC. And they each owned 50% of a company we'll call Trucking LLC. Then, on line 13, that's happened to be capital gains that they'd sold some equipment. And if it's farming equipment, it counts as income for farming. If it's non-farming equipment, it doesn't. So now we're going to look at this. We're going to look at farming income of husband for 2023 here. It shows $990,000. This non-farming income, which came from trucking and from sale of non-farm equipment that year, is $515,000. He qualifies to file Chapter 12 because it's greater than 50% of farming income in either the tax year before filing or both the second and third tax years before filing. Now let's look at wife. She didn't report any income in Schedule F like hubby had. She worked off the farm and ended up providing them with health insurance, which is a big contribution. And I find that many times one spouse is working off the farm. She had $253,000 from Farms LLC and sold some farm equipment. So she has a total of $398,000. Her non-farm income's $522,000. So alone, she could not file Chapter 12 because in the year before filing, her non-farm income exceeded her farm income. Together, though, they would qualify. So if they filed a joint one, they could file just based on the year before filing. So now let's back up a year. Let's see what happens to hubby and wife going back a year. And so if we go back a year, he still has his own Schedule F income. She got a little raise. She earned more money the year before. But in farming, each have $591,000 from Farm LLC. Trucking business hadn't done so well. So he clearly qualifies with $730,000 of farming income and $277,000 of non-farm income. She qualifies too. But we're looking at just that year alone because that's $591 versus $291. Remember, we've got to get in both second and third tax years before filing. So we now go back to the prior year. He again qualifies easily, and so does she. Therefore, hubby can file anytime, not a problem. If wife wants to file, she can file, but she's got to go back and rely upon greater than 50% of her income coming from farming in both the second and third years, which is what we had in looking at this, 591 to 291 in the second tax year before filing, and 186 to 134 in the third year before filing. This was a compromise that we negotiated with Senator Grassley back when this language was put in the code. The predecessor of Section 1232 was 1222A2A. And Grassley's concern as we were negotiating the language was, well, how do I make sure that somebody that might own a used car dealership doesn't come in and use Chapter 12 and get the good tax benefits from it? So we went back and looked at it. And before that, deadline for income or the requirement was 80% from farming. We dropped it to 50. And we gave the farmer another way in, and that way in was saying either in the tax year before filing or both the second and third tax years before filing. That helped a great deal, made it much easier for the farmer to come in. Now, as far as the used farmer or the car dealership, we're going to limit, when the discussions with Grassley were that we would limit the benefits of the tax part of that to the sale of farm assets used in the farming operation. Therefore, the used car salesman couldn't sell his car inventory out. And if he had a lot of gain on the car inventory, or he sold his used car dealership and had gain, he couldn't use Chapter 12 to avoid tax on that. So now let's think about the debt limit qualifications. What are the debt limits? Well, we got a raise coming here. At the current time, we're at $11,097,350. April 1, we get an increase to $12,562,250. That's brought in because of the automatic adjustment in Section 104 of the Bankruptcy Code. These numbers were published last week, Monday, in the Federal Register. So that will be helpful in that, we get a $1.5 million increase in the debt limit. Now the question I'm going to pose is this: what debt qualifies for that $12 million? What if you've got long-term real estate leases, 5-year lease, $400 an acre, or equipment leases? So won't sell you the equipment on an Article 9 transaction, they'll lease it to you. That qualify as debt to get you up over the $12 million limit. Well, isn't the plain meaning cause us a problem? Section 101.12 defines debt as a liability on a claim. 101.5 tells us what a claim is. It's a right to payment or a right to equitable remedy. When that farmer signs that lease with John Deere Finance for 5 years at $100,000 a year for that nice big combine he's got sitting out there, how much debt has he signed up for? Is he signed up for 1 year, or is he signed up for 5 years under the lease? If you look at plain meaning, probably going to have a problem. Or what about the farmer that's got 1,000 acres at $400 an acre on a 5-year lease? $400 times 1,000, and 1,000 times $400 an acre, that's 400,000. But multiply that by 5, now we're at 2 million. If he had a lot of other debt out there, or what if he had 2,000 acres? Or like the farmer in Northwest Missouri, 6,600 acres. We can easily get above the debt limits. We can look to sub V case law. based on consulting, they were dead on an unexpired lease. And that was, I believe, a factory type thing, or a lease of the office or something. And that counted towards the debt limit, and they kicked him out. In Zhang Medical, the court said, no, not going to kick him out just because the debt's above it. So now let's think about, how do we get the plan confirmed? We heard about bad faith, and we heard about dismissal, and we heard about sanctions with the panel before me. One of the first things to think about is, do we have a liquidation? We have to provide, it's the 7 versus 12 test. Exhibit 2 that I have in the materials is a liquidation analysis from a case I did in Illinois. And what you'll find is I footnote the heck out of a liquidation analysis, also my feasibility analysis. The reason I do that is I found that more clear I can make the information and communicate it, less questions I have from the court, the Chapter 12 trustee, and creditors. It's important that we be as transparent as possible. So, he had 301 acres of farmland, and he had a house and 10 acres. Now, in Illinois, exemption for a homestead is $15,000, but they're nice. They let you stack it. If you're in Missouri, like the clients I've been talking with in the last couple of days, exemption for a homestead is $15,000 per debtor, but you don't get to stack it. So hubby and wife get $15,000. When I talk to my clients who are from out of state, and I tell them about the Iowa homestead exemption, basically unlimited, they're envious, and they wish they'd started farming in Iowa as opposed to the other states they're in. Iowa's a better state to go broke in than the other states because you're going to get to keep more. So we're going to put all together. What I typically do is I will look and take information from the schedules themselves, and I will lay out in there what line on the schedule it is, and then if I've got liquidation costs, what my assumptions are, so you can see what's there. And I'll subtract out the exemption, and then if there's a secured claim, and whatever's left in the far right column is what's available for a Chapter 7 trustee that would be out there to pay priority claims and unsecured creditors. So I've now jumped to the bottom of the liquidation analysis. And this one, we had a little bit of other property, and we ended up, they had 3.5 million of assets. And by the time we did liquidation costs and we did some secured creditors, and this number here I can see is incorrect. I don't know why, because I had a much larger number up for secured creditor before. I had 1,000,001 that's not showing out here. At the end of the day, the amount that's available for the unsecured creditors in this one is about $832,000. Figured out Chapter 7 trustee fees, just went through the analysis there. So we still got 813 left to pay for priority and unsecureds. The priority tax claims we had at that one were 73,000. So we got to pay everybody in full. Because the unsecured claims that we had at the time were only 303,000. Projected selling enough farmland to do it, we could pay everybody in full. So we were required to pay 100% dividend, because I had more than enough money to do it. So I had $800 and some thousand, and to pay out my priority claims, I still got 739 left to pay unsecured creditors. Only had 303,000, so I had to pay them in full. So that's one of the things you've got to think about there in your putting together your plan is how are you going to put it together and what do you have to pay? So we got one of the confirmation requirements done. Another one is feasibility. You've got to be able to show that the plan's feasible. Now, include feasibility analysis on Exhibits 3 and Exhibits 4 to my outline. Biggest thing, outline all of your assumptions, whatever they are. What crops and animals are going to be raised? What do you expect yields to be? Are they comparable to past yields? What are the costs of production? Are they realistic? Are they in line with state land grant university costs? Are they in line with your prior costs? I like to use a 5-year average when I start on this. You've all heard the saying, figures don't lie, it's liars that figure. If you're doing a feasibility analysis, you have to be transparent, because if you're not transparent, you're going to end up with a problem. And I'm thinking about feasibility some more. What are you going to sell your commodities at? What's the basis of the projected price? Do you have contracts? Do you have a marketing plan? If you have a marketing plan, what is it? Does it require that you have some, does it require that you make puts and calls and pay margin calls? If so, where are you getting the money for it? Now, are you going to have crop insurance? At what level? 85%? 95%? Then there's a livestock revenue protection. Again, at what level? It's important to be thinking about all of that. Now for my favorite part of Chapter 12. Since most of my clients have to right size, we're going to end up with significant amount of taxes. Numbers on here come straight out of one of my clients' cases. I won't tell you which one, but we sold some machinery and equipment. We had depreciation recapture, tax rate, and I'm just showing you federal, it was 37%, so it was $18,500 with the taxes for the sale of equipment and the depreciation recapture. We sold a farm. The capital gains on that was $1 million, almost $1.4 million, 20%, $278,000. We had federal tax of just shy of $300,000. How on God's green earth are we going to help this farmer when he's got $300,000 of taxes? Well, the first thing you're going to do is you're going to together regular tax return. Calculate the tax due if all the income is reported just like normal. We call that the traditional tax return. See that in Exhibit 5. And you look at Exhibit 5, it shows taxes on the federal of due of $55,319. Quite a bit of money. After you've done that, you're going to do what I call a pro forma return. Pro forma return is one where you calculate all the taxes, but you exclude all the income from the sale of farm assets that are used in the debtor's farming operation. Now that's crucial, because once you exclude all of that, you're going to end up potentially with some additional tax. You may have some tax left. So if you have tax left, Exhibit 6 shows us that he's going to have $12,071 of tax. Whatever the tax that's shown on the pro forma return is priority tax that must be paid by the debtor. Now, the next thing we do is that we put them in a chart. We look at the traditional return, it shows 55,319. We do a forma return, the priority taxes, that shows us $12,071. The difference is treatable under 1232, and it can be discharged. That's crucial because if you discharge that tax, you're getting your fresh start. So now once you've done that and you've figured out what the tax is, how do you get the IRS to agree that's what it is? If I'm dealing with taxes for the years before I'm filing the plan, for example, if I file a case today and the farmer sold assets last year, and I've got one right now that we're doing that, where we literally sold out approximately $3 million worth of assets during last year. I will put the numbers for the traditional return and the pro forma return right in my plan. And I've got language in the outline that talks about doing that. The same thing I'm going to do, so I could get a confirmation order on there that says, yes, this is what it is if the IRS doesn't object. But what about if we have a tax return that maybe we're going to sell something after we file the case? The tax returns due potentially after confirmation. At that point, you're going to look at the provisions of Section 1232D, and you're going to file a report of submission of the submission and certificate of service for tax returns. The reason you do that is that in that, if you look at Exhibit 8, you'll see in there, we talk about the year of the tax return, the amount of the tax on the traditional return, the amount of tax on the pro forma return, and the difference is dischargeable. It's crucial at that point to also point out that if that's what's dischargeable, you give the IRS 180 days to file its proof of claim. So if the IRS files a proof of claim that matches your submission, great. Because once it files that proof of claim that matches your submission, game over. The trustee can put it in their report on claims. Now you'll see in here I have exhibits 8 and 9. 8's federal, 9's state. I do separate ones and I send the information to creditors and the addresses and things in there that I serve it on. When I serve the submission, I also serve a letter that explains everything that's going on. And I have the 2 tax returns, the traditional return and the pro forma return. That all goes together in a package. I send them generally by certified mail, return receipt requested, so I have proof of delivery that it got there. And if I don't trust the U.S. mail, I'll use up to FedEx, so I have a proof of delivery in case, say, they didn't get it. You do not file the tax returns with the court. You only file the submission, report of submission. The reason you don't file the tax returns, you really don't want identity theft going on. So, as I said, if the tax authority files its proof of claim within 180 days and it matches, you're done. Trustee just says they'll reflect the agreed amount, the report on claims, and everything's fine and dandy. What if the taxing authority files a proof of claim that's different from what you submitted? They say that there's not so much tax is going to be discharged, and that there's errors of some kind, or they believe you've erred. Go check. You might have made a mistake. If you don't think you objected, object to that tax authority's proof of claim, and the court's going to hear it. We'll have a contested matter that goes on. What if the taxing authority doesn't file a proof of claim? The 180 days comes and goes. Once the 180 days has come and gone, the next thing that you're going to do is, if they haven't filed one, you can file a proof of claim on behalf of the IRS or the State Department of Revenue. So once you file that proof of claim, it's going to match the submission that you've already told the court about. And at that point, IRS and the state taxing authorities are stuck. You can't amend it. You gave them 180 days to file a proof of claim. And this buttons it down pretty well. So at this point, what's happened is that if you file your proof of claim, and I have examples of that, examples 10 and 11 are proofs of claim, similar to ones I've filed for my debtors. So at this point, you can now see that you can sell lots of assets in a Chapter 12. And in Iowa, with the high prices of land, it's very difficult for us to have an operating Chapter 11 work. If we've got very much land and much debt on it, it's difficult to have it work. So most of my Chapter 12s end up being liquidating Chapter 12s. So I believe Chapter 12 is the most powerful chapter in the bankruptcy code because of the tax provisions, because we don't have committees, because we don't have the absolute priority rule, and much like Chapter 13, provided we can show the court that we've met the standards for confirmation, we get a plan confirmed, and it's relatively quick. Ready for any questions if we've got any?
I've got a couple that have come in that aren't through chat, but they're sent directly to me. Got a couple of questions. One is asking, should the tax returns be filed on before their normal deadlines if you're considering submitting the return along with the pro forma for the to the IRS for the 1232 consideration?
Okay, so if let's just assume I file a Chapter 12 tomorrow. My farmer normally would file his return by the 1st of March, or we might wait and say April 15th. I have no problem with the original return being filed normally as you would, but I would later then follow up with both of them being filed together. You're not going to be harmed by filing the original return on time. You're going to have to follow up with it and send them both. You do not end up filing the pro forma return. That's one of the things that confuses so many people, and it depends upon who you've got in the IRS that's working on your cases. Some of the people in the IRS understand it very well.
I was ready.
And if they understand it, and when you sent the submission and the pro forma in, things go quite well. But you're going to get some people that don't do it. We've had plans confirmed and discharges entered, and we've had the IRS come back and then try to collect the whole amount of the tax. And we've thought about going and filing contempts. Problem is, you got to go through all the administrative rigmarole before you can file a contempt on the IRS. What's worked best for me is to go to talk to the AUSA, the district where it's at, explain the situation. Usually they can get to the right people in the IRS and back down. Same thing with the state taxing bodies. You get to somebody in the AG's office, explain what's going on, and it gets done. I've been talking with a gentleman in Milwaukee who's now taken over watching things for Iowa and some other states. And they're actually trying to get some uniform standard across the country of how this is to be done. Uh, I've shared with him the things that I've been doing, and hopefully they will follow them or give us some other guidance as to what they want so that we're all following out of the same playbook.
I can see where that would definitely be helpful. And I know the association would like, I think they'd be willing to help in that regard too, if it's needed. Another question in the chat, has there ever been a constitutional due process challenge to Chapter 12 deprioritizing taxes? Doesn't it discriminate against all non-farmers, a class of people? Question mark.
There has, to my knowledge, there has not been a constitutional challenge. So you're coming into disparate treatment with different people. You've got farmers and you've got small business people, for example. I have been pressing Grassley and others in Congress to add a section similar to 1232 to subchapter V. And I'm also pushing there to get them to increase the debt limit to, from sub V to the little over $3 million up to the same thing that we're going to have for chapter 12. But I have not seen a due process challenge on that.
Okay. And another question was, if the debtor had sold property prior to filing, but did not file the tax returns timely, can the debtor file the returns late once they file the bankruptcy and still pursue the 1232 claim determination post petition?
I'll back this up a couple of ways. Even if they file the return timely, let's say that we're going to file a bankruptcy today, 2025, and they sold property in 2023. If they filed the tax return on time in 2024, we've got the IRS now chasing them. And fortunately, hopefully, they haven't gotten a tax lien, because once there's a tax lien, 1232 doesn't work because it has to be an unsecured claim if you read 1232. So and the question then is, if you file them late, can you get in? If you file them timely, I have no problem. You'll be able to go back and reassess that. That's not an issue. The question is, if you file it late, and that's going to probably depend upon the circuit you're in and what the courts have allowed in there as far as you discharge a late filed tax return or not. Now, the question is nothing in 1232 that talks about timing. In fact, if you read 1232, there's nothing in there that talks about doing a pro forma return or anything else. So we kind of made that up on the fly after we had 1222 A2A on the books. We had to figure out how can we determine the amount of tax that we're going to be trying to get rid of. And so that's what we ended up doing, is I came up with this idea, based it upon the going out of special use valuation, which is where I got the idea of the pro forma return. So if it's filed late, I think you're going to find there may be a difference within circuits.
Okay.
I try it. The worst that can happen is no.
Another question is, if you have done the liquidation analysis on the case after the filing, and you have a situation where you're dealing with a 100% payback, where there's similar to what you showed earlier, I guess, and that there's quite a bit owed to unsecured creditors. Do you and later there's a sale of property that anticipates or creates this reason to calculate the 1232 claim, or the deprioritized claim. Is that something that it's still an open door to do that, right? Or do you, if you have this large amount to pay as a minimum, do you just forego the process of determining what that tax would be and deprioritize it?
Well, if there's enough money to pay the tax in full, you're going to have to pay it in full. And I had a law professor ask me that, and he was kind of incredulous when I said, unfortunately, some Chapter 12 debtors have to pay the tax in full. Because if you don't have exempt assets that can eat up that extra equity in there, like in Iowa, I've had several people go through and dump 6 digits of taxes and come out with their house and 40 acres free and clear. Paid the creditor in full when we sold some other property. Creditors paid in full. The IRS in the state of Iowa have good sized tax bills. But since in Iowa, the home up to 40 acres is exempt, we walked out with a house and 40 free and clear. So but if we take it out and we're down in a state like Illinois or Missouri, where you've got $15,000 or $30,000 is exempt, you'll figure out the tax. And if there's assets to pay it, you got to pay it. Non-exempt assets to pay it, you're going to have to pay it. So in the plan, like I had showed you, we had planned on selling. In that one, we were actually selling the farm. And there was plenty to go around. Backside of it was, creditor got the case dismissed because of some other reasons, and the farmer ripped all the cabinets out of the house before he left. It was unfortunate that it didn't get done, and I really never heard from him after he skipped town.
We've still got some time here. I'm going to keep asking questions.
Go for it.
I actually have a question that I had written down that if you how would you avoid the extended delay when the final payment of a 5-year plan ends in, say, June, but you can't file a regular tax return until the next April? And assuming that your normal tax return is filed in April and the pro forma return is then calculated and sent to the IRS for that determination, 1232 determination, that would give them another 6 months. You're looking at basically October of the next year to get a claim in. That's about 16 months. That's after the final payment under the plan was made. I don't see a way to avoid the delay. And I don't, as a trustee, in some cases, I'm sure I'm holding money with the language in the plan not to distribute until I have all claims on file. I don't see any way to short circuit that. I'm thinking that it's going to have to be that way. And I'm curious how to handle a judge or clerks, those people who are going to be wanting to know why that case is still open. And have you had that happen, and how did you address it?
Haven't had that issue come up. As you can see from the materials, the trustee I appear in front of most of the time is Carol Dunbar. She handles all the 12s in Iowa. And I give her some cover by putting that language in there that says you can't distribute until we know there's no 1232 claim. Now, at some point in there, if we know there's not going to be a 1232 claim, we'll file a notice to the court that there will be no 1232 claim. Therefore, that provision of the plan doesn't need to be honored. Now, to the extent that we perhaps amend the plan, let's think about this. We've gone in, we got a plan confirmed, it's not working the best, so we amend the plan, and now we're going to sell Blackacre. And we sell Blackacre in year 5, and that's when we incur the tax, which would be the kind of situation you're talking about there. We've made all the other plan payments in there, but in year 5, we've now sold Blackacre, paid off a secured creditor, and maybe there's no money left. We could have a 1232 claim, and maybe you've got $100,000 sitting in your trustee account. I think you've got to say The plan language is very clear. I cannot distribute until I know there's no 1232 claim. And, Judge, you confirm the plan. You confirm the amended plan. We've got to give the taxing bodies their 180 days to file their proof of claim. I don't think you can get around that.
And the other thing I had was if in submitting the information to the IRS for the determination, the pro forma return, the regular return, when you send that in, and we've had situations I've experienced where the IRS has rejected those for different reasons. I'm just curious, or want to clarify or match up to what you've been doing, and that is that if you get that back, do you resend it, refile their notice with the court and start the time running again? Or do
No,
you
no.
or do you just send the information to the IRS again? What are you doing?
I go to the AUSA and I get them involved because they're going to be able to get to the right people in the service. We generally aren't getting to the right people in the service. How do you get to the right people? I think what you have to do if you want to get to the right people is you have to get to somebody who can go upstairs, so to speak, and say, hey, this is coming on. It looks like they've got us. Let's process this properly. I've had very good luck dealing with AUSAs, and in cases I've consulted with, that's usually what I tell people to do is let's go to the AUSA and see what they're saying, and then they usually are able to cut the bullshit and get me to the point where we're dealing with it, as opposed to kicking the can out and say, well, we don't know what this pro forma stuff is, and we don't have to deal with it.
Right. I have found that is a problem, that they just not all hands know what to do with those returns and the process that 1232 allows. So has been a bit problematic, but I think your ideas are really good at handling it. So, is there any other questions? All right. Well, Joe, thank you for your time today and your presentation. We appreciate you very much. Let's take about a 5-minute break and resume back at the first of the hour. We've gone quite a while now, and let's just take a short break and start back at 1 my time, but at the start of the hour.